Hello. Good morning, everyone. Are you able to hear me clearly? Hello. Hello. Okay. Give me a moment, friends. I just want to ensure that the audio and video is comfortable. After which we will start off with today's session. Yes. Is it all clear? Hold on. This is a one more minute, friends. 7.28. Now I believe still I need to hike it up. Let me know if the audio is becoming a bit too high. Okay. 10 dB. Now I believe it should be in the proper range now. 10 dB. If you find the audio to be too less or too high, please do let me know. Or if there is some form of echo also, please let me know. All right. One more minute I'll wait, and then we will start off with today's session on theory part, friends. Good morning, everyone. I can see the messages now. Good morning, Ashish, Swapna, Shilpa, Jaydev, Ashish, Parthasarathi, PS, Monisha, Purnachandran, Swapna, Yogini, Shilpa, Durga Prasad, Afifa, Chitralekha, Hariharan, Durga Prasad. Good morning, everyone. I believe everything is very much clear right now. So let's not waste any further time. Exams are very, very nearby. Let us start up today with our SFM theory marathon. Friends, the being a theory marathon, I'll be going a bit quick, but I'll be covering all the areas. First, let me explain to you and let me start with one particular topic: how to learn theory. Now, this is a very, very important question first that I would like to start up with. Good morning, Dinoy. Good morning, Midula. Good morning, everyone. Friends, the main issue that I find in many students when they learn theory is that, hold on, I think the lighting can be improved. Just a minute. This should be better. All right. So, friends, one of the main things that people lack when they learn theory is that most of you spend your time reading the theory and not recalling. Whereas, when you go to the examination hall, what are you supposed to do? You are supposed to recall, not read. So friends, here what I'm going to do is I'm going to show you two simple techniques that I used for my exams which helped me to score the best in theory. Method number one is picturization or visualization, whatever you want to call it, okay, where every theory that I learn, every chapter that I learn, I'll start with some particular background, a picture. With that one picture, almost majority parts of that chapter will directly come into my mind. From there, it becomes very, very easy for me to explain the remaining part of theory. I hope you are clear with this part. Second one important thing is what I call it as the paraphrasing technique. Paraphrasing technique basically means when you try to recall, you will not be able to recall 100% from your mind. So what we will do is we will create super short notes. Ideally, friends, first we prepare a short note. In my SFM theory, I will be sharing with you a PPT. Look, this PPT is basically nothing but a short notes already. This short note has been prepared from your study material directly, covering all the areas of your study material. Are you clear? So point number one, what we will do is we will make short notes. So here, since it's already available, you don't have to spend your time on that. Based on this PPT that I'm giving you, I will show you how you can make super short notes or paraphrase. There will be keywords. For example, I'll be just giving you this in the class. Now, I'm not sure if you can see this. This one page is enough for you to recall the entire startup finance chapter. Okay. So this, keeping this simple thing where we draw pictures, we understand the concept, we picturize the whole thing, we make super short notes, and after you make these super short notes, rather than reading, please recall. All right, rather than reading. So looking at these short notes, recall from your mind. After recalling, you will be able to recall at least 50% or 60% on your own. After doing this, you go and read through the theory. So this way, we are changing the order. Rather than reading and then recalling, what are you going to do? Recall and then read. Try this. It is very, very effective, because by doing so, if you already remember 60%, you don't have to recall that 60%. You don't have to read that 60%. You will only read the remaining 40%. I'll give you a minute. Can you put this in your books? All right, friends. I believe you are done writing this. Now, friends, in theory, what are the main theory based chapters that you have? All right, I'll categorize them into two parts. Okay, small theory chapters which can get over faster, the big ones. There is only one very big chapter, that is security analysis. It's a very, very big chapter. Okay, so we'll do this as a separate session on Monday. Today we'll cover the small chapters. The small chapters such as startup finance is there. Then you have a chapter called as risk management. Small chapters. It gets over very quickly. My effort over here will be to give you the picture, the paraphrase, and the logic, so that you can recall it from your mind and learn it very, very effectively. All right. Then there are small other chapters such as securitization. You have mutual fund, and then I believe you have mergers. All right. Hi, Joe Paul. Hope you're doing good. So these are the chapters that we'll be covering. So today I'll try covering the startup, risk management, securitization, and if time permits, these two also. If it's not getting over, we'll do it on Monday. All right. Today my session is going to be from 7 a.m. to 9 a.m. 7 to 9. Monday we will be doing a session from 6:30 to 9:30. All right. So by doing so, we will be getting a longer time to cover more amount of theory, and security analysis requires some more time than the normal time slot that is required. All right, friends. So shall we start positively with this now? Are you ready? Type ready and we will start off. Good morning, Sudha. Let's start off, friends. Let's start off. All right, fine. So we start with the first chapter, startup finance. Friends, what exactly do you mean by a startup? All right, startup is a company which has just started its business and it does not have sufficient funds in their business to grow. One of the biggest problems of any startup company is that they don't have funds. So if they are able to generate money for their business, then only this business will actually grow. Many a times startups fail mainly because they do not have funds. So we will just assume, we'll take a person from here who would be the startup person who wants to start a new business, and for starting this new business he needs some funding. All right, so let us take one person from this example. Let me take, whom should I take in my first example? Let me take Hariharan. Hariharan, hope you're doing good. Everyone interact with me. Let us assume this guy is Hariharan. All right. This guy wants to start a new business. What business Hariharan wants to start? Friends, whatever I speak, there will be a 10 seconds lag. Okay. So cooperate with me on that one particular part. Tell me, friends, Hariharan, what type of business will he be doing? Suggest some business I think my messages are reaching you a little late, so your response also will be a little late. Restaurant business, is it? Fine, friends. Let us assume that Hariharan is opening a new shop called as Hariharan's Idli Shop. What will he sell in Hariharan's Idli Shop? Obviously, he will be selling idli. To start this business, let us assume he needs 20 lakh rupees. Now, the bigger question, what we are trying to ask over here is that how is he going to raise these funds? Pani Puri business, Swapna. Vasudev also says Pani Puri. I think I've put idli now. Let's start with idli. We'll take pani puri for some other example. Tell me now, he needs money to just start this business. How is it possible for him to raise all these forms of funding? Come on, tell me one by one. Many of the answers you already know. Okay, so that is by itself is a part of the theory. What you don't know, I will guide you. Tell me what are the different methods in which he can raise money. Family funds, wonderful. He can go and ask his parents. Family, he will tell them, look, I want to start an idli business, give me money. Very good. What else? Friends, wonderful. He can go and ask his friends, please give me some money here, I will give you some stake and you can take it back. What else? Venture capital, that's a very, very good way of raising money. Just that it's a very long process. I have done a few pitch with the venture capitalists, it's not at all an easy task. Bank loan, very good. You can go for bank loans. There are a lot of bank loans that are available these days. Maybe you have to keep security. There are even loans for the startup companies. I forgot the name. I think they call it a Shishu loan or some particular terms are there. Out of which they will give you loan without any security also up to 10 lakh rupees. Then what else? Crowdfunding. Amrita, I want you to elaborate and tell me what exactly is crowdfunding. Jewelry, Swapna, how are you saying that you will keep jewelry as a security? Wonderful. Keep it as a security and then you can do it. Not an issue at all. What else? Fine. So friends, so many things you could already recall. So as I told you, first recall, then read. So these many points you really don't need to remember from your excellent. Someone has said own savings. That is also, own savings. It can be either from your own funds or you can be doing a part-time job. Many people do that. That is another way of doing it. Very good. Now I'll put the remaining with a reading pen. The areas that you did not remember. In that first one is peer-to-peer lending. Or friends, I'll in a simple term call it as a chit fund. Crowdfunding, somebody use this terminology, but I want you to let me know what is it. Amrita, yes. Crowdfunding is small amount of capital from large number of people. Excellent, Amrita. I'll give you a practical example of crowdfunding also. Plowing back of profits, wonderful. That is what you call it as bootstrapping that we are learning on a subsequent term. Bootstrapping, where you use profits of the existing company to be invested. But right now we are not talking about bootstrapping because we are talking about a startup which is just starting. All right. Future funding modes, one of them can be what? It can be bootstrapping. One more interesting thing, how you can actually raise your funds is what we call it as vendor financing, and there is one more thing called as PO financing. I'll explain these terms to you. First, can you draw this diagram in your books, all of you? Yes, Swapna, I also saw that somewhere. Idli ATM in Bangalore, 24/7. You put money or you swipe your card, instead of money, idlis will come out. Once you are done drawing, let me know done, okay? All right, I believe you are all done writing. Angel financing, yes, Swapna, that is another way, but you don't get it the moment you start business. Angel investors, venture capitalists also, maybe I'll put it that way. VC, angel investors, suddenly when your firm is at zero pace, they might not come in. But yes, in the subsequent phase, they will also come into the picture. All right. Some cases angels will come at the beginning itself, but that is like real angels. It doesn't happen practically. I mean, you just start a business and there are people waiting to put money into you. That's a very rare scenario. But yes, that also happens. Have you drawn this diagram, friends, in your books? So now when you look at this, when you draw this in your books also, the easy ones you put it in bluing pen, the ones that you don't remember, put it in reading pen. So those are the areas which you need to put your memory on, not on the other areas which is already there in your mind. This way, you read less, learn more. I hope you are clear, friends. Alright, I go to the next part now. I'll explain to you one by one. First one, I will go with the concept of peer-to-peer lending. Okay. Now this again I'll explain to you with the help of the example. There will be a chit fund. Let us assume there are four people, Mr. A, Mr. B, you have Mr. C, and you have Mr. D. Each of them will come with a chit concept. Chit concept is going to be very easy. What they will say is that each one of them will put 25,000 rupees every month. So every January, 25,000. Every month, 25,000 they will take out somehow from their other sources. Now tell me, in the chit fund, how much money is coming every month? 1 lakh. Alright. Like this, they will do it for, let us say, 4 months. So 25, 25, 25, 25, 4 times 4 people are there. They will do it for 4 months. Month number 1, 1 lakh rupees came. Out of this, the chit fund will tell, does any one of you need money urgently? So let us say he's Mr. A, Mr. B, Mr. C, and this fellow is Mr. D. A will say, yes, I need money. So the chit fund will tell him, how much discount are you willing to offer? So A will say, look, I am willing to offer, I am willing to take 90,000 from you in return for 1 lakh, which I will keep on paying as 25,000 every year. Let us assume B will say, I am more desperate. I am willing to give you 88,000. C would say 84,000. D would say, let us say 87,000. Now friends, who has bid the lowest over here? C. So what the chit fund will do is, in that 1 month, it will collect 1 lakh from 4 people and it will pay 84,000 to C. Chit fund will make a returns of how much over there? 16,000. Like this, every month they will keep on putting money, and this is what you call it as peer-to-peer lending. So 4 people coming together, they are actually 3 people are funding the first one in the first month. Second month they are taking the money back, and it's going on like this. Can you draw this image in your books now, friends? Once you draw an image, you will not forget. You will remember it thoroughly from exam perspective. I hope the audio is also clear. Please confirm if there is something which is not clear or uncomfortable. All good, Ashish. Thank you. Are you done drawing this? Can I go to the next part now? All right. So friends, once we are done with peer-to-peer lending, the next one is called as what? Crowdfunding. I will now explain to you what exactly is crowdfunding. In fact, I had involved in one of the crowdfunding discussions, even though it did not work out. There was a platform, which is called as Wishberry. Just check this. I think it's a Bangalore-based company. All right. They entertain crowdfunding. Now, crowdfunding, what they do is normally, people like us, if we go for crowdfunding, it will not work out. This has to be done by someone who's having very good public standing, like any celebrities, etc. In my case, when I discussed with one of the celebrities who wanted to release a movie and the funding required for the movie was 10 crore, Now there are multiple ways of raising these funds. They can take it from producer, but in this case, the celebrity wanted to raise these funds by way of crowdfunding. That means the movie will be released by an announcement in the public that we are coming up with a new movie and we want public to fund the movie. Subsequently, whoever is funding the movie will get a right to go and buy the ticket free of cost without paying any money. So let us assume there's something wrong with the website today, friends. There must be many other platforms also. Crowdfunding. Let's just search crowdfunding platform. Even though it wasn't successful, but the discussions went on, and that's how I was more familiar with Wishberry. When there are other things like Kickstarter is there. Okay. So what they do is they will be targeting some form of audience and they will be raising money. So friends, now let us assume I am collecting 100 rupees from let us say around 10,000 or 20,000 people. That would be equivalent to a very big amount. Am I right? That is how they raise these funds and they will be able to do it. That is what you call it as crowdfunding. I hope you are clear with the terminology of crowdfunding also. Yes, Jaydev, which is that movie where crowdfunding was possibly done? I also consulted a Malayalam celebrity itself, but it did not work out. Which was that movie? Just let me know, okay? Let's go to the next one. So crowdfunding part is clear. Peer-to-peer lending is clear. We go to the next one, which is called as vendor financing, and there is something called as PO financing. Friends, I'll just give you the concept of vendor financing. Ideally, this is nothing but trade credit. Friends, the trade credit concept is very popular in one of the industries, which is the diamond industry. All right. So here you have a particular supplier. Diamonds, the advantage is it will never get spoiled. Am I right? The supplier is selling to a diamond showroom. Is supplying to a diamond showroom. Let us say goods worth 10 crore. All right. You know, normally in diamonds, what they do is they go by a push model. What do you mean by a push model? You must have learned this in your SCMPE. The supplier will try to sell diamonds, will push it to the showroom. Why? Because they will tell you keep it in your showroom. Customers will come only when they see they will buy the diamonds. Correct? If they are not able to buy, you can always give back the diamonds back to the supplier. Supplier doesn't lose anything except for the time value. So what these diamond showrooms normally do is they will have 6 months credit, friends. And normally in diamond business, they have a huge margin of around 40%. So if they buy a goods for 10 crore, they sell it to the customer for almost 14 crore. Alright, but the problem is gold is more popular in India compared to diamonds. So the sale doesn't happen that easily. So these people get 6 months time. So indirectly, can I not say this fellow has taken a loan of 10 crore and he has kept it interest free for 6 months time? Am I right? That is the concept of vendor financing. Can you draw this in your books? Who? Swapna? I am not sure if I am supposed to disclose the client details. Code of ethics. Other chartered accountants will come and shoot me here. I just wanted to give an example. Amma Ariyan, let me check that. Jaydev, thank you for that information. Can I go to the next part? Okay, I believe you are done drawing this. I'm going to the next part now. Next one is called as what? You have one more thing which is called as the, bootstrapping, PO financing. Yes, let me explain to you what is PO financing. I had done this a few months back for one of the clients where they had a very good business opportunity. Let me call this client as Mr. A. All right. Mr. A is selling, let us say, wait, Saira, you want me to explain this once again? All right. Vendor financing is very, very simple. In a very simple terms, it is nothing but the credit period what you get from the vendor. All right. Now suppose I purchase on credit, I get a 6 months credit period or a 3 months credit period, etc. That 3 months credit period what I get is indirectly funding my business, yes or no? So for example, I purchase gold or diamonds worth 10 crore without paying money for 6 months. What does that mean? I am raising fund or I am getting diamonds in my showroom without paying even a single penny. That is what we call it as vendor financing or funding happening through vendor, because the diamond the vendor will buy, he will pay money, but we are not paying money. We are using that as a stock in my showroom so that I can sell it outside. I hope you are clear with that now, Saira. Ideally, Swapna, this goes in for all those business where the goods are not perishable or the goods run on a push model. For example, another example for this one is footwear industry. All right. So when you speak about footwear industry, got it right? Footwear industry, again, what happens? The chappals won't get spoiled that fast. You can push it into the market, but you cannot do it for fruits. Why? Fruits are perishable. You try pushing it, he will have to give it back. So that is on pull model. So there are two types of model that you learn in SCMPE normally, push model and the other one is pull model. Wherever you can push the goods, there you normally go by a push model approach. But after Amazon etc. coming in, even the footwear etc. is turning out to be a pull model driven business. Okay, I'll go to the next one now. PO financing. Suppose there is Mr. A. In our case, Mr. A had a confirmed order in Dubai where he had to sell some stock for 40 lakhs. Okay, confirmed order. What Mr. A has to do is basically buy this stock from Mr. B and he has to pay Mr. B 30 lakhs for this particular thing. Now Mr. A does not have money, but he knows that I have a confirmed order of 40 lakhs out in Dubai. He doesn't want to directly connect Mr. B to the Dubai client, because once he does that, Mr. B will, future selling will happen directly to the customer and Mr. A will not get anything in between. What Mr. A did was he brought an investor into the company. This fellow invested, let us say 30 lakhs. This 30 lakh was used to pay him. Alright, after this what he did was he sold it to the Dubai customer. He received 40 lakh after 2 months. So now the moment he received 40 lakhs, what he did was he paid to the investor 30 lakh plus a profit share of 3 lakhs. So total the investor got how much money? 33 lakhs in around 2 months or 3 months time, friends. He's got a 10% ROI in 3 months. That is huge. And Mr. A got a very big advantage over here. He got 40, he paid 33. What is the profit of Mr. A? 7 lakhs. Can you draw this in your books? I will slow down a little bit. Yes, cement industry, absolutely right. Even there you have the same trend going on. They will push. I believe you are done drawing this. Can I go to the next part now? Okay, I'll go to the next one. So we are done with peer-to-peer, crowdfunding, vendor financing, PO financing. Bootstrapping is basically funding from your own profits. You will be using your own profits will be reinvested. Okay, that is what we call it as bootstrapping. I hope everybody is clear with this part. So these are the different ways in which you can raise funds. So what you have to do now is you have to create a paraphrase in your books for startup finance, which I'll maybe give you in the end. Okay, you can just give a heading called as startup finance. In this paraphrase, number one that we learned is how to fund my business. Question number one. The moment you put this question, you will be able to recall from your mind friends, family, peer-to-peer lending, crowdfunding, PO financing. This is PO financing, that is crowdfunding, that is vendor financing, etc. etc. If you keep on recalling, automatically by just looking at this one single word, your brain will tell you what is the remaining part of the theory. Is everybody clear with this part now? Alright, you want to write down? I'll just slow down. Write down the PO financing slide now. Alright, I believe you are done writing this. So we are done with the first part of the startup financing. Now what I will do, I'll just go and show you the PPT which we'll be discussing. So here, innovative way to finance a startup, personal financing, we talked about personal credit lines, family and friends, peer-to-peer lending, crowdfunding, micro loans and vendor financing. Alright, personal financings, savings apart from the part-time jobs, etc. are used. That's what I told you. Part-time job, your own savings, etc. Personal financing can be part-time jobs, but personal credit lines, you must be having a credit card with you, another good way of raising money. All right. Family and friends, peer-to-peer lending, chit funding, crowdfunding or Wishberry, as I already spoke to you, micro loans, small loans that the banks are giving, vendor financing based on credit period, PO financing. There is one more thing called as factoring. Friends, I'll explain to you factoring when we do securitization. But in the diagram, you can please go and add factoring also. All right. Fine. I'll explain this to you when I do securitization. All right, friends. So we are done with the first part. Now we go to the second part, friends. The second part is called as a pitch presentation. All right. I'll just give you an overview of a pitch deck. This is when you go and pitch in front of either angel investors or you do it in front of venture capitalists, etc. etc. This is what you call it as pitch deck. Friends, I have been a part of many pitch decks. It's a very interesting process and it's a very interesting area of practice also if you are interested into this. But there are a few criteria. You should be very good at business valuations. You should be very good at presenting your ideas in front of the investors. If you can do that, then nothing like a practice in this area. All right. Pitch deck basically means we have to go and convince the investor that look, we are coming in and we have a very good project. If you invest 1 crore in my business, tomorrow you will be getting back 1.2 crore, 1.4 crore, etc. etc. Yes, Jaydev, Shark Tank is one of the best examples of pitch deck because they do it live on television. All right. I'll give you a very simple process of a pitch deck. Now, suppose there is a company now, Hariharan's Idli Shop. We'll continue with this example now. Hariharan's Idli Shop, they need a pitch deck. All right. What they will first do is, first ideally they start with something called as an internal due diligence. Why we do this is because your company has to be legally compliant. If your company is not legally compliant, then whatever happens, investor will never put money. There was one of the pitches where I went, the company was perfect, very good profit making company. It was doing things very well. The only drawback was it did not do its ROC filings properly. So what happened? One of the directors got disqualified. Due to that one reason, this company lost a funding of around 20 crore. It's not a small amount. So internally, your company should be very, very strong and very, very stable. Point number one. After you do this, we should prepare something called as a financial pitch deck. Hariharan will prepare something called as a business pitch deck. So Hariharan's pitch deck will basically consist of, how idlis are made, how he's going to make the best idlis in, South India, etc., etc. All right. Financial pitch deck is basically where we will give projected financial statements, ROI, payback period, IRR, whatever you learned in your FM inter classes, FM final classes, everything will come over here. All right. After you prepare this, you do a valuation either by a registered valuer or by a merchant banker. This will give you the value of the company. Fourth step, what we will do is called as a term sheet. Okay, these are practical things, friends, not there in your theory, but always this you can add, because this is what happens in the industry. Term sheet is basically a one-page summary contract between the investor and you, where you will tell them, look, I am going to raise 50 crore. I am raising it by way of equity share or by way of preference share or by way of debenture. Tell, out of 10 rupees share, 30 rupees is going to be the share premium. Conditions, after 3 years, you can exit the company if you want. When you exit, I will pay you this much amount of money. Basically, all the terms and conditions what are required will come in the term sheet. Once the term sheet is prepared, the next part which comes in will be the external due diligence. This is normally done by the investor company to check that we are all thorough. This is done by the investee company or whatever you want to call them. External due diligence will come over here. After this, they will finally enter into an investor agreement and they will close the deal. All right, this is what happens in reality. A bit more in-depth process of this is what is coming in your theory, which I will share it with you now. Can you please put this in your books? All right, friends, I'm going to the next part now. Write down quickly when I'm speaking so that you also are at par with me. Anyways, the recordings also will be available. I want to complete this entire thing as soon as possible. All right. Now, once we have put up this entire thing, the pitch presentation will have a certain things to be taken care of. For example, introduction. Let me see if I can share some pitch deck with you. Hold on. Just a moment, let me check if I have a pitch deck right now available. I will just show it to you so that you also can get a hold of what I'm talking about. No, these are all okay. All right. I'll just quickly show you a sample pitch deck. All right. I just quickly brush through it. I don't want to share the intrinsic details. Just want to show you how a pitch deck is actually prepared. All right. All right. If you look at this, this is a pitch deck which is prepared so that we can explain to the investor what we are intending over here. So there are multiple things that comes and every pitch deck will be slightly separate. They'll give a company profile, what are the options that are available with you, who are the team members, meet the team, what is the problem you're trying to solve, what is the solution you are looking at, who are the core customers, market outlook, opportunities, competitive landscape, weakness, etc., etc. And then you come to the business valuation part, where you do same thing what you learn in your SFM, friends. Yesterday there was a question from pitch presentation in our mock, is it? So we do the same valuation as we do it in your SFM class, present value of future cash flows and free cash flow to the firm, the financials we will share, the revenue we will share, the expenditure, profits, etc. What are the assumptions made, and finally we close the pitch deck. I just wanted to give you a fair idea about how a pitch deck actually works. Alright, so we use exactly the same thing that you learn in valuation. Present value of future cash flows. So you predict the future cash flows, PAT plus all the things that you learned in my class. If you are one of my students, then yes, that entire process is what happens in reality also. And that is how we actually pitch the whole project. Yesterday in your mock exam, they gave you a pitch presentation. That was very good. So that is how the pitch actually happens. So here they will ask you, who are you? What do you do? Who is the members in the team? Same thing that you saw there. What is the problem you're trying to solve? Ola, electric, what is the problem they are trying to solve? Petrol is becoming a big mess. Let's go for electric vehicle. Swiggy, what is the problem it's trying to solve? I am tired of going to the hotel. Let the food come to me. Oyo, what is the problem Oyo is trying to solve? I want to go and sleep in a hotel. I'm not getting a good hotel. Oyo is trying to solve that. Every big opportunity comes from a big problem. If there is a big problem, there is a big opportunity lying under that. All right. Then you give a solution to the problem. If the problem is big, the more money you can take. Smaller the problem, the lesser money you can take. How are you going to market? How are you going to sell a particular thing? What are the milestones that are coming in your company? What are the financial projections? P&L account, balance sheet, cash flow, competitor analysis, business model. Swiggy does not have any employees. They work on a subcontracting basis. Every company has got some different business model. Yes. Then you have a financing, who has invested till date, how much more money you require. Okay, these are the parts which comes in case of pitch presentation. Are you all clear so far, friends? Okay, now even before I proceed further, how do you access this PPT? All right, I'll explain that to you. In order to access the PPT, you have to visit my website tarunjagdish.com. Okay, click on classroom. I will add you to the batch. All right, there is a batch called as SFM, sorry, not this one. There's a batch called as study material questions. So here I have given in fact the videos of all the study material topics also, like for example mergers. You want to do the study material problems of mergers, it's already solved over here. All right, security valuation is solved, IFM is solved, everything is solved over here. Plus if you come to study material theory SFM, this one PPT is around 120 slides. It covers the entire short notes of all the chapters that you are having. All right, friends. So you can just take the PPT from there. I will add you to the batch. Once you install the app, I have to add you all. I will be adding you to the batch. All right, friends. Right. Let's go to the next part now. Where was I? Okay. I believe everybody is clear with pitch presentation. After this, the next thing that you have is called as the modes of financing. Modes of financing. Now this is something what we already have spoken earlier. There are other ways of funding. In this they mention about bootstrapping. That is one of the methods. The second method is called as trade credit. Already we discussed in the beginning. The third one is factoring. I'll explain factoring in the chapter of securitization. All right. The next one is what we call it as leasing. All right. Bootstrapping we already mentioned to you. You are trying to do it from your own funds. Trade credit we gave already an example of what? Diamond industry. This one we will learn it separately in the chapter of securitization, because that's also a form of factoring. Leasing means rather than, for idli shop, he will require some machinery. The idli maker will be required. He will take idli maker on rent rather than purchasing. All right, friends. Can you please write down this in your books now? I believe you are all done writing this, friends. Can I go to the next part now? All right. So we are done with the different modes of financing also. Friends, yes, one more thing comes over here. Okay. That is where we talk about angel investors, and the last one is VCs. Okay. Angel investors can be people from your relatives, people who come as angels to you, who trust you, and who are putting money into your company by way of, a trust that they have and the confidence what they have in you. VCs are proper professional people. They will put your money into the company only after understanding the whole thing, after genuinely checking that the business is actually very much profitable. Okay. Yeah, Saira, you have to download the app. Okay. How to download the app also I'll tell you. App, you can either be having an Android, okay, or you might be having an iOS app. If you're talking about Android, you just have to search CA Tarun Jagdish and my app will come. Install the app from there. All right. You don't have to request anything. I will add you. If you are in iOS, you have to use the Class Plus platform. Install the Class Plus app. Then I will give you a batch code. ORG code is there. I think the ORG code is, you have to go and enter the ORG code as ELEVM. Yeah. Just do that and you will be able to use the whole thing. All right. This is how you can download the app and you can view the PPT over there. All right. Due to some security issues, they are not letting it on in the desktop version. Fine, friends. I'm going back now. Okay. So I believe you are all done writing this. Angel investors. Then what we have VCs. Venture capitalists are also coming in this case. Okay. So that is about the modes of financing. We will go in depth of this now by way of PPT. Modes of financing: bootstrapping, already told you, own profits, trade credit, as I told you, diamond, etc. Industry, you get a better trade credit. Okay. Then you have factoring, we will explain this in securitization. Leasing, you go for rent. Angel investors, they invest in small startups. They are sometimes among your family and friends. They invest in enterprise rather than business. I told you, they invest based on trust, not exactly based on the profitability that they see over there. All right. VC funding are investment vehicles that manage the funds who want to invest in startups. They are professional people. They will invest in high risk companies and they will take high profits also. But be very careful of VCs, friends. There have been very bad experiences also. Sometimes the VCs will come, put some money, become 51% shareholder, throw the investors out, the main company runners out, and they will run the whole show. Sometimes the VCs will come, study the process, understand the technology, copy it and do it on their own. Lot of negative nonsense also happens in the market. I've had some terrible experiences with some of the VCs. It's always not the same, some of them, and some of them are very genuine also. I hope you're clear with that. So when they invest, the VCs are investing in different types of horizons. Okay, the characteristics are like this. They may invest from 3 year to 10 year. Okay, they will be making investment mainly for liquidity shortage of the company. So for example, I have a business, I have profits, I have sales, but I don't have money for working capital. That is where they will capitalize. It is having high risk, so they will get high returns. They participate in equity, help the company to grow. But VC, one advantage is that, friends, now for example, Swiggy. They had a company called as Mirai Assets who invested into Swiggy. Mirai Assets is a VC. The moment they pumped money, suddenly many other VCs also started pumping money into them. Why? Because confidence breeds confidence. One fellow has put money, we can also put. So once you get one VC in your hand, you can ideally go and get multiple VCs coming into the picture. Alright friends, next one. The merits are long-term funds, business partner, they have experience in IPOs. Nasdaq is something similar to NSE in India, NSE or BSE in India. Nasdaq is something which is there in the global markets. Alright friends. Now, there are various stages for funding also. Seed money funding, small money, okay, when there is a new idea. Startup, you need idea for marketing. First round funding, early sales. Then you have second round funding, that is mainly for working capital requirement. There is a third round funding, that is for expansion round. Bridge financing, when you want to go to the public. This is what Zomato did. Zomato first took money from VCs. They went till the seed money, they got the startup, they got the first, second, third, and now they are public. So the shares are listed, okay, and that is how they take this forward. Here, friends, one theory from your textbook I want you to learn. It comes in page number 14.10. I'll download and show you. We will take the ICAI Board of Studies Knowledge Portal. Startup Finance, page number 14.10. Yes, this table. Friends, this table is something what you have to just learn. Seed money, period the fund is blocked is 7 to 10. High risk, startup, very high. First stage, high. Second stage, sufficiently high. Third stage, medium. And fourth stage, low. So just go through this, friends. Same thing what we discussed. But in exam, when the question comes on this part, you have to write down based on this one particular table. I'll give you a minute. Please read through it, friends. All right, friends, I believe you are all done with this part. Okay, I'll go to the next one now. Now, these are how the process happens. I earlier told you due diligence, etc. This is how the process is given in your textbooks. Deal origination. First, there is a deal. You have an investor, investee, both of them speak. Okay, they will go either directly or indirectly through the intermediary. Practicing chartered accountants, in many cases, they can connect because you have a lot of clients. You already know who has money, who does not have money, where is a good opportunity lying. You know, VC will focus on many areas like sector. Some VCs are there who will focus only on IT. They will not put money anywhere else. Some VCs I know he will put only in jewelry because they know the jewelry business is easy for them. Second one, people sometimes put money based on promoter. For example, they will say, Elon Musk is investing, I will also invest. Turnover focus. Some VCs will put that where there is high sales, means there is going to be high profits. Like this, VC has got multiple focus areas. Based on them, they will be investing money. They will do screening. Here what they will do, they will check the details, they will check the financials, they will do their internal analysis of the company. After internal analysis, they will do what? Due diligence. I already told you about this. They will take the information thoroughly, they will audit the company. Alright. After the due diligence, everything is okay. They will go for deal structuring, a win-win deal where you will be giving them equity share at a face value plus you will be offering some form of premium. Alright. Promoter will retain the right to buy back the shares. There is lot of conditions that comes over here. You have a 30-40 page investor agreement which is normally used. After the investment happens, the VC will have a board of directors, strong MIS, budgetary control. They will keep on reviewing things are going properly or no. Company should be strong corporate compliance. Filings has to be done on time. GST has to be paid on time. No legal issues should come on the company. They should be having an exit plan also. You can get can be given in detail. You can either sell it to the third party, get into IPO, buyback commitment at an agreed rate, multiple point, but they keep an exit plan because you can't be expected to be with the investor forever. All right, friends, that is how the whole VC investment process goes. Just go through it, friends. Deal origination, screening, due diligence, deal structuring, post investment activity, exit plan. All right, friends, now there are two types of VC funding that happens. I will draw a diagram and explain that to you. VC funding can be done either by domestic people or it can be done by offshore people. All right, domestic people are VCs who are existing in India. They are very limited, not many are there. Offshore are the main people. Offshore people, they invest in India in two forms. One, they try doing it directly. Two, they try doing it indirectly because of the legal structuring, friends. Taxation, etc. is a big mess in India. RBI will intervene if lot of foreign money is coming into India. So they have to be very careful about how the funds are bringing into India. All right. So here they have two things. One is called as structure. Other one is called as unified structure. Domestic is very easy. Offshore, you are having directly would mean offshore. What they will do is called as offshore funding. Here they will take the advice of this fellow. Okay, they'll take the advice of the Indian investor and they will directly invest in the funds. So this fund might be a mutual fund or it can be any form of trust. He will put money over here, let's say 100 crore. From here, this company is an Indian company. All right, from here they can put money in project 1, project 2, project 3, etc. The other format is that the overseas manager will directly put the money in a fund over here. Now, from this fund, the money will be invested into a trust. So now from here, what they will do, they will be routing the money to P1, P2, P3. So this will be a company which is foreign owned. This will be a company which is having Indian stake. And only then finally they route the money into the company. So can you please draw this chart in your books now? I believe you are done, friends. You can draw this now in your books. I believe you are done writing this, friends. Can I go to the next part now? Write down this also. I believe you're done writing this also, friends. Can I go to the next part now? So that is how the venture capital process happens, and we are done with the chapter, friends. Last, they are teaching you about something called as Startup India Initiative. Friends, there is a registration called as DIPP, Department of Industries Promotion or something like that. And there is something called as KSUM, which is Kerala Startup Mission or Karnataka Startup Mission. Like that, every state is having a startup mission. What these startup missions do is they will give all the guidance that is required for the startup companies. All right. For example, they will help you if you are a private company with a turnover of less than 100 crore. All right, you have a scalable business model, so they will help you with funding also. In fact, in Kerala, everywhere is different. Me being from Kerala, I know areas of here, they fund around 12 lakhs as grant. If you have a very good idea and you have a very good expansion plan, they'll give it to you without any security. It's not that easy as I'm telling. It's not that the moment you go there, they'll just give you the money. They'll do a lot of scrutiny, a lot of questions will be asked. But if everything is complied, then they actually raise and they help companies to grow with this funding. That is what we call it as Startup India Initiative. Normally, this doesn't come in the exam. They'll only ask you about the definition of a startup because every state has got a different startup initiative. Okay, every state government also intervenes into this. So for you, this theory will be more than sufficient. And we are done with this chapter, friends. Are you all clear with the conceptual area and the logical area of this chapter? Yes, friends, I'll now give you a paraphrase with which you can recall the entire chapter. All right. Paraphrase. Okay. We will talk about startup. You just have to make a chit. Okay. Preferably a small paper, fold it in your hand. So just by this, you should be able to go to your rooftop, have a nice walk and recall. That way you get a good movement. You are not sitting the whole day. You will get tired sitting the whole day. 10 minutes it will take, you will be able to recall the entire thing, then you read through it. So when you go to talk about startup, inside this I will put first thing. What was the first thing? How to fund my business. This is question number 1 that we spoke about, correct? Second thing that we spoke about was pitch deck. So inside pitch deck, I think we had multiple things. One, we had the VC process. One was the content of pitch deck. So that is one heading that you can write down. Content of a pitch deck. That is one thing that we learned. Second thing that we learned over here was VC investment process. Third tricky area that we had over here was what are the different types of VC funding that is happening over here. Correct? Third, I think we learned, sorry, this came under modes of financing. Sorry friends, I have made a small mistake. Under pitch deck, you only had content, nothing else. I'll remove this. Under modes of financing is where you had bootstrapping, trade credit, etc. But mainly what we learned over here was VC. So what will you learn? The process of VC. How is that, what they are doing? And there was a table that I asked you to recall. So just write down table. You can recall that table, seed level, every time expansion process, etc., etc. Then we talked about characteristics of VC. Okay, that you can recall. Characteristic. Then you have process of VC and how the structure, basically that offshore funding, etc., etc. Looking at this one chit, you will be able to recall the entire startup theory from your mind. Can you write down this in your books now, friends? Then we'll go to the next chapter, risk management. That's a very simple chapter. All right, friends, I believe you're all done writing this. I'll go to the next part now. We'll go to the next chapter heading now. Security analysis we'll do it on Monday. Okay, let me finish the smaller chapters first. That one chapter will take around 1.5 or 2 hours. But exam wise, it will not be covering so much. Okay, so we'll just go quickly. We will do the other easy chapters first. Then we will go to that chapter. All right. All right. Risk management. All right. Friends, first let us understand the difference between the word risk and there is another heading called as uncertainty. Right. Let me ask you a question. Let me take one person from this classroom. All right. Saira, you have installed the app. I'll add you. Right now the class is going on. After the class gets over, I'll add all of you to the batch. Okay. Now, everyone interact with me. We are talking about risk and uncertainty. Let me take one fellow from this class. Let me take Saira. Let us assume Saira is a highly brainy person. All right. Saira is someone who works very hard. And let me take one other fellow, assuming that the other fellow is lazy. Let me take for example, whom should I take? Swapna. I am taking you as a lazy person. Swapna is a very, very lazy person, whereas Saira is someone who is very hardworking. Both Swapna and Saira go to write the SFM examination. After the exam gets over, Saira meets Swapna. Saira will ask a very simple, or Swapna will ask a very simple question to Saira. Saira, tell me, how was your examination? How was your SFM examination? Saira will tell, as per how my experiences and how I wrote the paper, there is going to be a 30% chance I will score 70 marks. There is another 50% chance I'll be scoring around 60 marks. And there is a 20% chance I might score around 40 marks. The moment Saira gave this reply, Swapna is shocked. Then Saira asked back the same question to Swapna. Swapna, how was your exam? Then Swapna replied, God knows how my exam went. Friends, this is the difference between two terminologies. One is risk and the other one is uncertainty. Risk is something which can be calculated and managed. Alright, so there is something that I can do about it. There is some calculation involved. Uncertainty cannot be managed whatsoever. Tomorrow there is an earthquake. Nothing you can do. Understood? It's out of our control completely. You are attending class lying on bed. Swapna, please get up. Please. So this cannot be managed. So this is the difference between risk and uncertainty. We are learning a chapter called as risk management. So what we are trying to learn over here is that how we can manage our risk, reduce our risk so that our profits can actually go up. Quickly, can you put this in your books? Many other people will be lying down and attending class. They must be looking at this like a Netflix movie. Can't help it. Alright friends, are you all done with this? Let me go and explain now. So here what we will do is, first we have to understand what are the different types of risk. Risk number one is called as strategic risk. So what I'll give you in paraphrasing will be, okay, I'll give you examples. One example for strategic risk that you can remember is Kodak and the other one is online classes. Alright friends, Kodak, strategic risk means, having a risk of losing your business because of change in the market, but you are unable to change. Your strategies are still the old. Do you know friends, Kodak was one of the most popular camera related business sector in India. What they used to do was take photos, you will get negative. I'm not sure how many of the youngsters today have seen that. Yeah. Jopal, relax. I'll come to that. You don't have to lose your confidence at all. And I'll tell you why. I'll come to that part very, very soon. Everyone interact with me now. Kodak used to take a photo. You will get a negative. You take the negative and what will you do with the negative? They will give it and then they will convert into photo and they will give you. Kodak actually came up with the digital camera first. But what Kodak did was, they were scared. The moment digital camera will come, people will never come to us for negatives. We will not be able to sell our traditional types of cameras. So what Kodak slightly did was, it suppressed the digital camera technology. 3 years, 4 years, they could survive. By the time, other people came into the market with digital camera. Very soon, digital camera became so popular and Kodak lost its complete market. That is a classic example of what? Strategic risk. Another one very good example that you all can relate to is online classes. Friends, pre-COVID, pre-2020, everywhere offline classes were at a boom. You used to see students coming in crowds, 100, 200, 300, attending the classes. Suddenly, when the COVID came, lockdown happened, people had no choice but to stay back at home. Suddenly, people started attending online classes more, and they had no choice at that time. 2 years, in these 2 years of time, students have got so much comfortable with the online classes that even now, many of you are attending my YouTube live and you are actually understanding and enjoying the session also. During this 2 years of time, friends, so many faculties lost their market only because of one reason: they were unable to convert themselves from offline mode to online mode. Again, that is an example of what? Strategic risk. That again became an opportunity for many young faculties who were good at technology, who could learn the technology fast, and who could actually take the online platform also to the next level. I hope you are clear with the example of strategic risk. Joe Paul, stay back. In the end, I'll tell you why you should not worry about the mock test and why you should not lose your confidence because of that. Now, I want to go with the flow of the chapter, so please bear with me. Point number 2 is the second risk that comes over here is called as compliance risk. Compliance risk. Friends, this is basically the risk of non-complying with law. For example, GST, okay, or Companies Act. Many of you must be also, doing some form of part-time practice. You must be consulting some clients, or you must have done articleship. You must have dealt with many of the clients. How many of you pay? How many of them actually pay GST on time? Most of the Indian fellows don't like paying GST. All right, I had a terrible experience with one fellow. He collected 10 crore rupees and he's telling, I don't want to pay GST now. I don't have fund shortage. I will pay later. I told him, if you don't pay GST now, your life will become miserable. That fellow told, no, no, no. I know officers in the GST. That fellow will help me. This, that, etc. I told him, take your own risk. I am not signing this report. After 2 years, that fellow comes back to me telling me, I have got a notice from the department and my close friend who was the GST officer has resigned from there. That one person, friends, he was some 60, 65 years old. He had a killing business for the last 30 years. He had yearly turnover alone on his name, 100 crore, 110 crore, 120 crore, alone in his name. This one fellow, because of the notice coming, he was in total soup. They asked him to pay 5 crore upfront. And he had some cash flow crisis because the clients were not playing. His clients were all big players, BHEL, Bharat Heavy Electrical, and all the big projects. So what they do is they will not pay the money until you provide proper accounts. This fellow did not have proper accounts and he was pretty old to learn all those things also. He got a notice of 1.5 crore plus 1.5 crore penalty plus 1 crore of interest. Almost 4 or 5 crore they asked him to pay. And they told him, if you don't pay it, you will be arrested. This fellow's life became miserable. He finally sold his house, sold his land, everything, and repaid that amount. Then he's gone into a form of a chronic depression. He keeps on blabbering about this affair to any person he sees here or there, and he's lost his complete business. This is one of the risks that you face when you don't comply. So friends, if any of your clients don't comply, tell them the story, convince them to somehow come into this and comply with the thing. If you don't comply with the law, you may end up losing your whole business. Many gold showrooms, they sell in cash to save the income tax. One showroom got stuck. They went and caught them red-handed. 35 crore of cash sales was caught. It was stocked as unidentified income. 300% was the penalty. 100% was the tax amount. So friends, 330 crore if you talk about, 9 crore income tax, that's 30%, plus 3 times 27 crore penalty. For 30 crores of sale, he had to pay 36 crore as penalty. That business collapsed right there. So we have to comply very much with all the legal parts also. That's what we call it as the compliance risk. The third one is what we call it as operational risk. With Jaydev, I didn't see your message. Nokia and touch screen. Nokia lost its entire market exactly because it did not comply or did not move into Android. Yahoo, yes, Yahoo was so popular. Now Yahoo has shut down its operations in India. All right. Yes, yes, you save a lot of traveling time provided you attend the class by sitting and not lying down. Okay, fine. Operational risk. Operational risk is, friends, day to day business. You can end up doing any form of mistakes which can actually create a lot of problem for you. One miserable problem which I came across was when we formed a company. All right. After forming the company, there were two directors, A and B. All right. Now, what we had to do was we had to remove A and B and we had to add C and D. All right. Very simple process. You have to add C and D, remove A and D. What my staff did was they first went and removed A and B. After that, they tried to add C and D. But the problem what happened was the moment they removed A and D, the company became directorless. Now they are unable to add C and D. That company became directorless. I had so much headache because of this one thing, friends. Run from Calicut to Kochi, Kochi to Chennai, meet the RD, listen to their insults and everything. They were not willing to correct it and they are telling us to go by a different process. Finally, after a lot of headache and spending 1 year, this matter I could resolve. So friends, it's a very, very tedious and a time consuming and a headache process because of one operational mistake done by one of the articles. Example number 2 over here is that I ask one person to pay 1000 rupees. By mistake, he will add one other zero and he will end up paying 10,000 rupees. This is another example of what? Operational risk. Let us go and check the different other forms of risk, friends. Strategic risk, compliance risk, operational risk. The next one is financial risk. This is very simple, friends. You take a loan, you don't repay. Automatically, you will understand what is financial risk. Bank fellows will come, they'll make your life miserable, take your money, and maybe even it can end up in you stopping your business if you're unable to repay the dues with the profits or the turnover that you have. That is what you call it as financial risk. Inside this, they are having multiple other forms of risk like counterparty risk. Counterparty risk means I do my part, other fellow doesn't do his part. Now this many of you must have come across. Friends, what happens is, suppose one fellow needs a loan, okay? You prepare a project report and you give it to the client. Now what is client supposed to pay? He's supposed to pay you the fees. Client doesn't pay his fees because he did not get a loan from a bank. He did not get a loan for multiple reasons, but he will put the blame on us and he will not pay us our funds. This is a simple example of what? Counterparty risk. We do our part, they do not do their part. Are you clear with this part, friends? Next one, political risk. Another very, very interesting form of risk, friends. Here, earlier Congress was ruling, then BJP came into the power. People who are supporting Congress, for them this becomes a political risk. And when demonetization came, that is a classic example of what? Political risk. You lose out on the business because of one particular decision taken by the national political companies who are parties who are running the whole show. All right. Then you have something called as interest rate risk. What is interest rate risk? This you have learnt in your SFM class. There is something called as floating rate. Okay. So what happens when you have a floating rate? You know the interest may go up. That is an example of what? Interest rate risk. Currency risk. Again, you have learnt in your IFM chapter, friends. Currency risk. You sell for $1 lakh. Today the spot price is 50 rupees. After 1 year, the spot price falls down to 40 rupees per dollar. You lose how much money over here? You lose 10 rupees per dollar. Am I right? That is what you call it as currency risk. Then you have something called as liquidity risk. This many companies face. You have sales, but no cash flow. Every sale is in credit. Every purchase is in cash. You don't have liquidity. That's called as liquidity risk. These are the different forms of risk. Can you please write down this in your books now? One moment, friends. All right, friends, are you all done writing this? Hold on. Yes, can you please write down this also in your books now? My laptop is getting hanged. These nonsense messages keep coming, friends. We need to. All right, done removing it. Can you please write down this in your books now? Friends, just send me a hi. I believe I'm getting your chats. I believe yes. Okay, so I believe you are all done writing this also, friends, in your books. Fine, friends. So these are the different forms of risk, friends. So this is it. This chapter is mainly about all these forms of risk: strategic, compliance, operational, financial, counterparty risk, political risk, and interest rate risk, currency risk, etc. Now they will tell you how we can manage this risk. So first we learnt about what are the risk involved, and subsequently what are we going to learn? How are you going to manage the risk? VAR, value at risk, is a practical part, friend. So I'm already just doing it. Yes, I can see your messages now. Yes, I did block him, Purnachandran. Okay. VAR is already covered in the problem driven area. All right. So that way this part is now clear. This I'm not covering in the class now because it's a problem driven area and I have covered in my regular classes. I don't think I'll have time for this right now because we are focusing on theory. Theory wise, it's just one question it's trying to answer. If I invest 100 lakhs, what is the maximum loss I will be making in one particular day? Everybody clear with this part? Okay. Now they will tell you how to manage the risk. This is actually a common sense things, friends. So we'll take it one by one. Counterparty risk. These people don't pay money to you. How do you manage that risk? Take advance. Whenever you do works like project reports, business valuations, etc., do only on 100% advance because it should not be contingent on the outcome of them getting a loan or getting an investment. Only the monthly related works that you do, like internal audits, etc., and the client is trustworthy, only in those cases you can ignore the advance part. That way you can actually reduce the counterparty risk. The points they have told over here is that you can do due diligence. Don't commit too much on one party. Very, very true. Know what is your exposure limit. Keep a credit limit. Political risk. How do you, control the political risk? One is diversification. Now, we can set up offices in India, outside India. That way you have a diversification coming in. Or you can do an in-depth study of how the political behavior will affect your business and take a proactive action on that. Here they have told study about the political behavior, evaluate the macroeconomic conditions, inter-country contracts needs to be drafted, blah, blah, blah. Third one, interest rate risk. Friends, this we have already learned. We can hedge it using what? Cap, Collar is there. Then what do you have? Floor. So I'll write down all that over here. This one will be study political behavior. Now, when you talk about interest rate risk, what we will do about interest rate risk is that we can use cap, you can use collar, you can use floor, you can use interest rate swap. There's a whole chapter focused on this. FRA is there, IRF is there, IRO is there, etc. Artishwari, I need to add you. I'll add you after the class. Only then you will be able to view the theory. Okay. So that's about interest rate risk. Currency risk also we have learned, friends. We have learned many ways of taking care of the currency risk, like money market hedging. Do you remember all those things? Forward, future, options, etc. etc. We learned many hedging techniques, home currency invoicing, leading versus lagging. All that will come as currency risk. All right. Now, next one is what? Okay, this is technical analysis. By mistake, it has come. That's it, friends. Can you write down this also in your books now? These are different ways in which you can reduce your risk. So the whole chapter is about what are the different forms of risk, how do you manage these different forms of risk. Okay, friends. All right, friends, I believe you are all done writing this. Fine. So we are done with this chapter also. Now we go to the next chapter called as securitization. This is another easy chapter provided you know the background. Otherwise, this chapter will look very, very complicated, friends. What I will do is I will explain this chapter with the help of a movie, Brahmastra. Friends, have you seen this movie Brahmastra? If no, then we can take any other celebrities that you want. I just need some people for this example. How many of you have seen this movie Brahmastra? I'm taking that because you have multiple celebrities involved in the movie. You have Ranbir Kapoor, Alia Bhatt is there. Then you have Bonnie Roy, who's the villain in the movie. Amitabh Bachchan, who is there. Nagarjuna is there. Multiple starrer movie. Have you seen this? Or being CA finalist, you don't have time? No? Okay, then forget about this movie. We'll talk about some other particular movie. Forget about Brahmastra. Tell me, I want three people mainly for the first example. Okay. So in the first example, I need one very, very decent actor in Bollywood industry. Second, I want some crooked, cunning actor in Bollywood industry. We'll talk about Bollywood because students are attending from multiple places. All right. PS1, we can talk about that also. Third, I want to give me a name of your favorite villain. We'll start with a basic example. Okay, fine. Tell me any decent actor. Forget Brahmastra, forget everything. Just tell me a name of any decent actor in Bollywood. We'll talk about Bollywood here, okay? Shilpa, Bahubali. He's a decent actor. All right. So we'll talk about. But then Bahubali, if you take Rana, will be the villain that you will tell. So what happens? Okay, do one thing. We'll take. No. That will not work out. Bahubali will not. It will break the. Avengers, fine. I'm okay with Avengers also. Tell me one decent person in Avengers. Rajkumar Rao. Vikram. All right, we'll talk about Vikram. Tell me the name of the celebrities. Okay, who's Rajkumar Rao? I'm bad with these names of the celebrities. This guy. All right, all right, all right. So Rajkumar Rao. We'll take Rajkumar as a decent actor here. Now tell me one cunning actor. Any one cunning actor? Vikram. We will take Vikram over here. Vikram, I'll take it as a villain, or tell me some other villain. RDJ. Jaydev, who's RDJ? Vasudev, you want Alia Bhatt as a decent actor or cunning actor? Captain America. Ranbir Kapoor, Salman Khan. Let us do one thing. We will take Salman Khan as the cunning actor, and we will put, let us say, Captain America as the, not the villain exactly, as the, okay, I'll remove the term villain. I'll put Captain America over here. Okay, let us assume that Rajkumar has sold some goods to Salman Khan. What goods has Rajkumar sold to Salman Khan? Some goods he has sold for a value of, let us say, 100 lakhs. All right. Now, after he sold this, Vijay Sethupathi, okay, I can take that fellow. That fellow is the one who was there in this movie Vikram, right? Okay, we'll take Vijay Sethupathi. I'll need more celebrities, so keep them ready, okay, in your mind. Rajkumar has sold some goods of 100 lakhs to Salman Khan. Then, when a Being Human t-shirt, wonderful, yeah. So now Salman Khan is supposed to pay money to Rajkumar, correct? But Salman Khan, being a cunning actor, will not pick up his call. He will tell, I'm busy, blah, 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 etc. And he will not pay the money. Rajkumar is fed up, calling Salman Khan, going behind him, not getting money. Finally, Rajkumar will come to Vijay Sethupathi and he will tell him, sir, please help me. I want to get the money from Salman Khan. So now what will Vijay Sethupathi do? He will use all his contacts and connections. He will go and he will fight with Salman Khan somehow, collect the money and give it back to Rajkumar. This whole scenario is what we call it as factoring. Sam Anderson, Vasudev. I don't want to take that fellow. Karan Johar. Please draw this image in your books. All right, friends. Hucha Venkat. No, Swapna. Sam Anderson is something of a different level. Homework for all of you. Research on Sam Anderson. Are you all done writing this? Okay. So this is a basic picture. Friends, this whole scenario is what we call it as factoring. And securitization is the same, this process which is legalized under the Securitization Act. So this is normally done for banks, friends. Why? Because banks will have lot of receivables, all right, and there will be a customer who must have become an NPA. Okay, they call this a customer as pool of assets because there will be customer A, customer B, etc. And then what they will do is they will hire some third-party professionals. Okay, So these people will do what? They will, bank will hire them, they will go to them and make them pay the money to the bank. Are you clear, friends? So you can draw a second image also. Image number 2, securitization. Now friends, what we'll do is we'll make this diagram a little bigger and bigger, because everywhere when the diagram will come, there will be some changes. Ideally, 3 people are enough, but when they do it professionally, there will be lot more people who will come into the picture. So each of that I will give you with separate diagrams. So the image is very clear in your mind. After that, this chapter will become very, very easy for you, friends. All right. Now, let's go and understand. I believe you are clear so far. So here, if you see, what are they doing? Creation of financial instrument. So if you talk about a technical term, this person is now a financial instrument. All right. Bundling and unbundling. Bundling means there will be a lot of people. Okay. Let us say A, B, C. I take it together. That is what we call it as bundling. If I break it up into, out of this I make A, B as one and C as a separate one. Now this is what we call it as unbundling. They will do it based on the risk. For example, A might be having outstanding for 3 months. C will be having outstanding for 1 year. So they will break it up. Long fellows separate, small fellows separate. Bundling, unbundling. Alright. Then they are telling they are using some tools of risk management. Structured finance. So they are trying to arrange money for this entire thing. Okay. Trenching. Clubbing assets of similar risk together. I'll just draw that over here and explain to you. Trenching. What they will do, less than 60 days, one asset. 60 to 90 days, another asset. And the last one is beyond 90 days will be another asset. Are you all clear with it? That is what you call it as trenching. Okay. Next part. Higher risk, higher premium. So here if I just go, here you will have a higher risk, higher premium. All right, friends. Can you please go through this now on your own? Write down this financial instrument, bundling, unbundling. These terms, once you understand this chapter, is very, very easy, friends. I believe you are done. Please write down this in your books now. Yes, financial instrument means what? For example, sundry debtors. Isn't that a financial instrument? It is a financial asset. Am I right? Here it is an asset for me because I have given loan. So what I receive is what we call it as a financial instrument. I hope you are clear, Saira. Fine, friends. I believe you are all done writing this. So these are the terms. Homogeneity again means similar type of assets. Now even actually 60 to 90 etc. is also one form of homogeneity. You can categorize it in multiple ways. For example, you can categorize them as male, female, that is also one form of homogeneity. I'm just giving you an example over here. Alright. Now here there are multiple other terms that we have to bring into the picture now. First one is formed as the originator. Originator is the person who is actually creating this entire thing. So in our example, Rajkumar is the one who created the whole process, right? Sometimes what happens is Rajkumar might not be the one creating it, somebody else might be creating something. So there is someone called as the originator. In our example, we will keep this as Rajkumar. Alright. He will create something called as SPV. What is the full form of SPV? Special Purpose Vehicle. Inside this vehicle, everybody will come. That is, Rajkumar will come. And then who will come? And the villain will come. Who was the villain, friends? Vijay Sethupathi will come. And other parties also will come. I'll tell you that one by one. And that's what I'm going to elaborate the diagram slowly. Okay. Rajkumar will come. Vijay Sethupathi will come. And then what will they do? They will try collecting from whom? From Salman Khan. Can you draw this diagram in your books now? Alright friends, I believe you are done with this. So from originator point of view, it becomes an off-balance sheet financing. Friends, why we call it as off-balance sheet is because bank is having a receivable of 100 lakhs. Bank has told this fellow to go and collect it. But can the bank pass an entry, Vijay Sethupathi account debit to loan? Can they pass an entry like that? No, they cannot do that. Why? Because ultimately, in whose balance sheet will it come? It will come in the bank's balance sheet. So this transaction between bank and Vijay Sethupathi is an off balance sheet item. It is only an understanding between the bank or understanding between Rajkumar and the Vijay Sethupathi that this person, Salman Khan's receivable, ideally it will be in his books, right? The entry will be what? Salman Khan account debit to sales. Correct? Now he cannot pass an entry that Vijay Sethupathi account debit to Salman Khan. He cannot pass an entry like that. So it will stay as debtor in whose books? Rajkumar's book only. But who is going to be the person who is actually going to be receiving this money? Vijay Sethupathi. Are you all clear with this part now? Okay. That is why it's called as a off-balance sheet item. By doing so, you can specialize more in your main business. So Rajkumar can now focus on what? He can focus on acting rather than running behind Salman Khan. It will help you to improve the financial ratios because you will get better collection now. It will reduce borrowing costs because you will receive money faster. I hope you are clear with this part. A background image in the theory note shared is too bright. I'm not following Anima. Which one is bright background? It's very clear over here. I can see it myself. It is written in black and white PPT. You mean the yellow, the red? You want me to make it black here? Can you try from a separate device? I think it's some technical issue on your end. Others, can you please let me know? Are you finding the theory note to be too bright? Anima, can you just, in the app, is it? Let me take the app. Hold on. Slide 1, slide 2. What is too bright? I have given examples over here. That's all. The same examples what I have given you here. It is not a PDF. It's a PPT. See, it's very clear here. Anima just WhatsApp me. It must be something that the way you are downloading it, some issue must be there. Alright, just send a screenshot to me. I will do it separately. Let's not disturb the class because of that. Alright. So where was I now? Okay. So these are the benefits of securitization, off balance sheet, more specialized in main business, helping the financial ratios and reducing the borrowing cost. Alright. Are you all clear with this part? Can I go to the next one now? Right. Originator. Then there is someone called as the investor. Now I will explain to you what is an investor. Alright. Investor means, now I will again draw the same image. I will give a heading called as investor. So who is the first guy we have over here? Rajkumar. He has hired whom? He has hired Vijay Sethupathi. Alright. And he is supposed to get how much money from Salman Khan? 100 lakhs. Sometimes what happens is Vijay will have a contact with some other celebrity who is very rich. Tell me a name of any rich celebrity, friends. Let me assume myself. Tell me some rich celebrity's name. Any particular name, friends? Some rich actor. Can I take Bahubali here? So let us assume Bahubali is a very, very rich actor. You want to take SRK, Shah Rukh Khan? Adani. Fine, we'll take Adani over here. That makes sense. We'll take Adani over here. Amitabh Bachchan. We will take Adani over here. So friends, Adani, what he will do is, this fellow has to get 100 lakhs from Salman Khan. This fellow will directly give him a loan of 90 lakhs. Alright. Why? And in this case, Adani is what will be called as investor. Why he gives 90 lakhs is because tomorrow now Salman Khan will not pay 100 lakhs to Rajkumar. Salman Khan will pay 100 lakhs to whom? Vijay Sethupathi. So what Vijay will do from this is, he will pay to Adani 95 lakhs. So what is the advantage of Vijay Sethupathi over here? He makes a profit of 5 lakhs. Adani has invested 90, he's got back how much money? 95 lakhs. So here we have an investor, that is the part that they were talking about. Can you draw this diagram in your books now? Please draw this in your books. Black Panther. Ashish, you seem to be watching English movies more. Alright, I believe you are done drawing this. So that's how we come to the investor. Investor point of view, what is the first one? Diversification of risk. He will put money with Vijay Sethupathi. He will invest in another company, multiple companies. So he will be getting his money back. Alright. He will have protection against default. They will normally give some security. He will not give any money without any form of security. And there will be some regulatory requirements also. So there is law which will be also protecting him. Everybody clear? That is from whose point of view? Investor's point of view. Then we'll talk about the primary participants now. Everyone tell me who is the first primary participant in our example? Originator. We spoke about him already. Initiates the deal, is called as a securitizer. It sells the assets lying in the book. So Rajkumar had an asset of Salman Khan. He sold Salman Khan to whom? Vijay Sethupathi. Originator transfers both legal and beneficial interest, but accounting wise it's an off balance sheet item. So legally now who's Salman Khan is supposed to pay money to whom? Salman Khan is supposed to pay money to Vijay Sethupathi. Everybody, correct. Salman Khan is supposed to pay the money to Vijay Sethupathi. Everybody clear with this part now, friends? Can I go to the next one? Then we spoke about SPV. We also spoke about investor. Everybody clear? SPV is a company under which the Vijay Sethupathi will come. Investor will also come. So if I go to the earlier example, Vijay Sethupathi came, Rajkumar came, and even who will come? Adani will also come in the SPV. Because now who is he? He is the investor. Everybody clear? You can go and add Adani also in SPV, friends. Alright. Okay, he is going to be the investor. Then there is going to be secondary participants. Who is a secondary participant? Debtor. So in my example, who is going to be the debtor? Salman Khan. They owe money to the company. There will be rating agency, for example, CRISIL. Now, friends, the diagram becomes even more elaborate. I'll put it over here. You have Rajkumar. Okay. Here you have Vijay Sethupathi. Here you have Adani. So I'll just put the names. You have Rajkumar. You have Salman Khan over here. In order to evaluate Salman Khan, two other people will be there. Okay, one fellow will be CRISIL, credit rating agency. He will tell Salman Khan is having AAA rating or AA rating, etc. Based on that, they will be able to understand how much risk is there with Salman Khan. Are you clear with that part? Here you have Vijay Sethupathi, who is a factor, and you have whom over here? Adani. You will also have one more fellow over here. He will be, let us say, Sanjay Dutt, a very good friend of Salman Khan. Sanjay Dutt might stand as a guarantor. Now tell me, what is the role of the guarantor? He will tell, I guarantee you, Salman Khan will pay the money. If Salman Khan doesn't pay, I will repay the loan for all of you. That is what you call it as guarantor. Everybody clear so far? I'll give you time to write down. So we have obliger, we have rating agency. You have a receiving and paying agent. This fellow will collect money. In my example, Vijay Sethupathi itself is the receiving and paying agent. Or he may keep some staff under him. We'll do one thing. Let me make the diagram even more bigger now. Under him there will be an assistant. Okay. This assistant will be the receiving and paying agent. Everybody clear? So he will collect money from Salman Khan, pay money to Rajkumar, pay money to Adani. All the work will be done by whom? The assistant. Everybody clear? You will have an agent or a trustee, somebody who will be overlooking everything. Let us put a big fellow over here. Let's make this Amitabh Bachchan. He will ensure that everybody is happy, no problem comes to anyone. Alright? Amitabh Bachchan, he is going to be what? He is going to be the trustee, overlooking the entire operations. Alright? Credit enhancer, that is what I told you, he is Sanjay Dutt. He is a guarantor also, and he is also called as credit enhancer. Alright, structure. Structure is basically this whole picture is what you call it as a structure, where everybody comes together. Friends, peacefully now, can you draw this diagram in your books? With this diagram, the entire securitization comes in one place. Alright friends, I believe you are all done drawing this. With this whole picture now, securitization will become very, very easy for you. Let us now discuss and let's complete this chapter. Alright. So, receiving agents collects the payments, agents will oversee all the partners, credit enhancer will give you assurance that the debtor will make the payment, structure is which brings together all the parties, originator, investor, etc. Alright friends. So now here, this is the mechanism of securitization. Creating a pool of assets. In my example, the pool of asset is going to be what? Salman Khan. Transfer to SPV. So you are transferring the whole thing to a special purpose vehicle. Sale of securitized paper. So what you will do, you will sell the papers to them. What is the paper? Salman Khan is basically the paper now. He is the amount receivable. That is a bill. That will be sold to whom? It will be sold to Adani. Sold to Vijay Sethupathi or Adani. Many a times these two people are the same, okay? Sold to Vijay Sethupathi. Administration of asset, who will do the administration? Amitabh Bachchan will do the administration. Recourse to the originator. There are two types, friends, with recourse, without recourse. With recourse means if Salman Khan even then does not pay the money, loss will be suffered by, who's the first guy? Rajkumar. Without recourse means if Salman Khan does not pay the money, entire loss will be suffered by Vijay Sethupathi. Alright? With recourse, Rajkumar loss. Without recourse, it will be Vijay's loss. Repayment of funds, who will do the repayments of fund? Salman Khan will do. Credit rating will be done by whom? CRISIL. Alright? Yes, Jopal, I am giving you the whole summary now. So the summary in the picture will go like this. Rajkumar is selling to whom? Salman Khan. Salman Khan doesn't pay. Rajkumar gets in touch with Vijay Sethupathi and he creates an SPV. For this SPV, who are the parties in SPV now? Rajkumar is there, Adani is there, Vijay Sethupathi is there, Amitabh Bachchan is there. Alright? And there is an assistant who will be the receiving and paying agent. Now, they will start putting pressure on Salman Khan to collect the money. Salman Khan will go to CRISIL and get a credit rating, which will tell that Salman Khan has got very good rating. He will bring Sanjay Dutt into the picture, who will stand as a guarantor. If Salman Khan doesn't pay, Sanjay Dutt will pay. Considering all this, finally Salman Khan will pay the money and the SPV will be closed down. SPV is basically a company. It can be an LLP or a private company, anything it can be. Are you clear now, friends, with the whole story? Yes. So they create a pool of assets. They create Salman Khan as an asset, transfer to Vijay Sethupathi, and sale of securitization also will go to Vijay Sethupathi. Amitabh Bachchan will administer the assets. Recourse or with recourse, without recourse, repayment of funds will be done by Salman Khan, credit rating by CRISIL. I hope you are clear now. Jopal, I believe you are clear with this now. Alright. The problem is we don't understand this picture. So we find it very, very difficult. Now you learn through it on your own, you will understand it very, very quickly. What are the problems in securitization now? Let us understand the problem. First one is stamp duty. Friends, in India, you have to pay stamp duty of 12%. So if I create a stamp duty for 100 lakhs, I have to pay 12 lakhs as duty. Who will waste 12 lakhs of duty on money that I am not going to receive? I may receive, I may not receive. Income tax point of view, there is absolutely no clarity, friends. How do you tax this whole thing? Whether it's coming under 30% tax, whether it's a capital gain sale, whether it is a normal PGBP, no idea, because it is something which is an off-balance sheet item. There are multiple opinions which exist on taxation. Okay. Accounting wise, I told you it is an off-balance sheet item. Without recourse means what? It will finally, if the loss happens, who will suffer the loss? Vijay Sethupathi will suffer the loss. How do you pass an accounting entry for that? My first entry will be Salman Khan account debit to sale. How much? 100 lakhs. Now, Salman Khan didn't pay the money. Alright. But the loss is suffered by whom? Vijay Sethupathi. So I will have to end up passing an entry in my books, P&L account debit to Salman. But I'll get money. I'll get money from whom? But I'll get money from Vijay Sethupathi. So I'll have to show bank account debit to Salman, even though actually the money has come from whom? Vijay Sethupathi. Lot of complications are there in accounting points also. Lack of standardization. There is no standard rules in India. There is inadequate debt market. There is no proper debt market in India where you can actually invest. Like Adani doesn't put money in all the deals like this. You need to have a proper this thing. There are no legal power. There is only one act in India which is called as the SARFAESI Act. I think you have studied this act. It's a very small act. It gets over very soon, correct? In fact, after doing this, you will be able to correlate with SARFAESI also, but it is not very effective. It's a 5 or 10 page maximum, not very much efficient. All right. They can do securitization using three instruments. One is called as pass-through, other one is pay-through security, okay, and the last one is called as stripped security. Final part with which we'll be completing today's session. There are three types of instruments, friends. First one is called as PTC, pass-through certificate. Second one is called as PTS, that is pay-through security. And the last one is called as stripped security. Pass-through certificate means in this, Rajkumar will give in writing, he will tell that whatever money Salman Khan has to pay me, instead of paying to me directly, he can pay to whom? He can directly pay to Vijay Sethupathi. That what money I have to get from Salman will be passed to whom? Vijay Sethupathi or Adani. That is called as pass-through certificate. So that certificate gives Vijay Sethupathi a right that Salman Khan's money is no more Rajkumar's money. That money is whose money? My money. Pass through. The money will come to me directly. It will pass and it will go to whom? It will go to Vijay Sethupathi. That is what you call it as pass-through certificate. What is the second one that you have over here? Second one is called as pay-through security. Here what happens is there will be some security which will be kept. For example, Rajkumar will keep gold with Vijay Sethupathi. So tomorrow, if Salman Khan doesn't pay, okay, Vijay will sell the gold. So basically what is happening here, they have a security underlying that. So in this, the SPV debt security are backed by assets, gold, other instruments, whatever. It is backed by some form of assets. Are you all clear with this part also? Last one is called as strip securities. Inside this, what they do is they strip or break the loan into two parts. One will be interest only security, and other one will be principal only security. So let us say what will Adani do is, Adani will give him one amount of loan for which repayment that he will get will be only principal. Okay, he will not get any interest. And let us say this is done by Ambani. So let us say the total amount receivable is how much? 100 lakhs. Adani will pay, let us say, 80 lakhs. In return of which he will be getting only the principal amount. Ambani will pay 20 lakhs. In return of which he will get only interest. So now what will happen? Normally when you take a loan, I take a loan from a bank. I pay interest separately. I pay them interest also, principal also. Am I right? Here, I will be paying principal to one fellow and I will be paying interest to one other fellow. That is what you call it as stripped security, because you're stripping it into principal separate, interest separate. Can you draw this diagram also in your books, friends? With this, we are done with the whole securitization and we are completing with today's session also. Are you all clear with the entire law, friends? Not the law, entire theory part that was covered today. Monday, we will do mutual funds, mergers, and after that, we will go to security analysis. All right, friends? Please write down this in your books. Daniel, I'll explain strip security once again. Let everyone finish writing this first. See, what happens in stripped is, normally if I need 100 lakhs, I take 100 lakhs only from Adani, right? Here, I will take 100 lakhs from two people. I'll take 80 lakhs, that is the principal portion, present value of principal portion from Adani, present value of interest portion from Ambani. Alright, so what I'll do, interest I'll keep on paying to Ambani, principal I'll keep on paying to Adani. So let us say with interest I end up paying 140 lakhs, him I will pay 100 lakhs, I'll just minimize myself, I will pay him 100 lakhs, to Ambani I will end up paying, let us say, 30 lakhs. Total repayment is going to be how much? 130 lakhs. Are you clear now? Alright friends, I believe we are all done writing this. So let's pack up our session with this part, friends. Monday we will have the next session. Stay tuned to the YouTube channel, subscribe it, so whenever I'm going live, you'll get a notification. Monday also mostly I'll do it in the morning itself, friends. Alright. So someone told that you got demoralized because you went and wrote the exam. Listen to me very carefully. You have to write these mock texts. We have to face these failures now rather than facing it in the examination hall. Many a times, mock test paper is normally tougher than the main examination paper in many cases. Never judge your results based on the mock test paper. It's a hands-on experience. We have to have some experience of writing, not getting the answer and losing out over there. But keep doing it again. Write more mock papers. Write with the intention of failing. Let's face that failure. Let's face that fear of failure first. Only if you are able to overcome that failure part, you go to the examination hall, you are already experienced. With that experience, when you finally go and write, you have a much higher chance of winning. I took up my registered valuation course recently. November, I took the course. December, I went to write the exam. I did not have any mock test. First exam I went and wrote, I failed. Now I became absolutely depressed. My God, I suddenly started losing my confidence. I started thinking, will I ever become a registered valuer? That moment, one thing struck me. I have failed once. Let me try again. I have some experience from this. In the next 1 week's time, one other RV exam was going on in Thrissur. I booked my tickets. Without studying, I went and wrote the second exam. This time, I cleared. So, understand one thing. You fail in a mock test doesn't mean you will fail in the main exam. Second thing, you get through the mock test also does not mean you will be getting through the main exam. But this writing the exam will give you confidence. It will give you the experience, hands-on experience. Ultimately, what is important? Is your knowledge more important or the application of the knowledge more important? It is your knowledge and application. So you get experience by applying in the mock test. So do not miss out on any of this. Write and finish it off. Alright friends, I'll pack up my session with this now. Vasudev, that's the first chapter. I'll cover that also. So Monday, let us do mutual fund mergers and chapter 1. Security analysis, we'll keep it for some other day and we'll do it separately. Alright. So see you on Monday morning. Have a nice time ahead, friends. Take care. Thank you so much. Jopal, that's even better. Do it again. Write the same mock test paper again. Try that. It will really work. Try writing the same test paper. You will overcome that fear. I used to write every one question paper 2 times. First time, it used to take me 3.5 hours. Second time, the same paper used to take me 2.5 hours. That used to tell me that yes, I can do it. So don't worry about the mock test. Write, face the experience, do what you can do. Just go and do it. Okay? See you on Monday. Have a nice time ahead, friends. Take care. Saira, I will add you to the batch. In the next 1 hour time, you will be added to the batch. I will just add you and you can just go to batches. You will be able to see it. Okay, I will send a message also. Alright. Thank you.